Welcome to Money Talk. Coca-Cola, United Technologies, and Twitter are just some of the big cap companies that reported earnings beats this quarter and led the S&P 500 and the Nasdaq to record high levels. But with the economy in its late cycle, will the market ascent ease up or even fall apart? Joining me is options strategist Phil Davis, founder of philstockworld.com and PSW Investments. He joins us from Fort Lauderdale. Phil, how are you?
I'm great. How you doing?
I'm doing well, thanks. Great to have you on. Let's just start. We'll get into the plays because I know people are like, get on with it, get to the plays, but I promise we'll get there. I'll give you a little context here because if I think back, December, November, that time, I mean, the markets were coming down hard. And then, fast forward to, I think, just a couple days ago, and you see the banners on the screen saying S&P new all-time high. So what do you make of where we are right now?
Well, in the fall, we were shorting the market because we felt that we had gone too far too fast. And but also the depth of the drop in December we started buying again when we got towards the end of the year because we were very excited about being able to buy at those lower prices. I think on the whole, most of the damage is done by what I call self-inflicted wounds. In other words, stupid trade wars that you don't need to be having, the Brexit moron, idiocy over there. Things like that are just, they're not really anything wrong with the global economy. There's something wrong with the global leadership. And once we get past that stuff, or once it normalizes a little bit, we're on a pretty strong footing economically overall. In fact, I'm very impressed with the way we did rebound so fast.
Tell me about some, if you take a look at some of the stocks making up the indices, what do you see? Is it a healthy rebound? Are there lots of stocks participating?
Well, you know what? I was very nervous going into this quarter, and I thought that we were going to have some earnings problems and such. But last week, 1 week ago today, in fact, in our morning report, we analyzed the Nasdaq, and we looked at the top 10 components of the Nasdaq, and we looked at each company one by one to decide whether or not it was actually worth what it was when the Nasdaq was hitting 8,000. And as it turns out, you can make a justification case for the Nasdaq. The top 10 stocks on the Nasdaq are 40% of the composite index. They're almost 50% of the Nasdaq 100. And if those 10 stocks can justify their position now, and the earnings coming in tonight, you can see they're even doing better, then the entire Nasdaq is probably justified at about this level. Crazy as it seems.
What about what about the fact of what I said when I was opening up to you? We're in the late end of an economic cycle. Do you believe that? Where are we from an earnings perspective? How can we get more upside from here?
I think the real upside is coming from automation. I think we're sort of in the beginning of, there are the normal cycles that you were talking about, and you're right about that. We are hitting into, we've really exhausted this part of the normal cycle. But there's this super cycle building of automation and AI, and it's really happening. It's all very science fiction-y. We've heard about it for many years, and it never really caught on. But they're making leaps and bounds progress with automation now, to the point where I think every year you're going to see these incremental moves up and up and up in corporate profits. It's not good for people because they're going to replace all these people with machines, but it's fantastic for corporations and their bottom line.
But what is that?
Especially large ones.
Yeah, and I guess the one point is, does that dislocation of people ever start to hit the bottom line if people don't have enough money to buy, or do you expect another cycle will begin in terms of those people getting reemployed again or redeployed somewhere else, I guess?
I think we're heading into a decade of turmoil where you will see, well, first of all, you're going to see these large companies that are able to automate are going to start destroying their competition. So you're going to see bigger and bigger corporations taking over. You're going to see more and more people thrown out of jobs that have to find something else to do. But there will be other work, and there'll be other ways to deploy income that's being made. But it's going to be very disruptive. There are going to be some very ugly cycles. There's going to be blowback on it. There'll be people screaming for legislation. All sorts of weird stuff is going to be happening. It's going to be interesting, to say the least. Interesting
to go into, and also with this election coming up, too, whether that's all going to kind of sync up for that. Let me ask you, though, just sticking with the market, we've seen the markets come back to all-time highs. At the same time, we've seen just a whole bunch of IPOs come out, Lyft, Zoom, PagerDuty, Pinterest, Uber set to come out. Does that tell you anything about the cycle?
In the traditional, investment banking sense, these guys are the money. Look, the money's out there. People are willing to handle this cash, to lift, and so on and so forth, regardless of whether or not anybody makes money. And then if you look at Amazon or somebody like that, they play out the scenario where, well, give someone a chance because over time they might make your money back, even if they don't look like they're making money. I think they're striking while the iron is hot. I think they're worried because in 2008, we saw the liquidity like that dried right up. So while the money's out there, while the market is ripe for these IPOs, while these unicorns can still get bidders, even though they're not making any money, now's the time to strike and get out there, and that's what they're doing.
All right, last question for you before we get on to some of the calls and that type of thing. But I'm curious, I'm hearing two things from you, I guess. Is like you've got this, automation super cycle on one hand, which I think sounds bullish for the right companies anyway. And then you've got this disruptive, lots of things could happen, trade tensions, all that kind of stuff. So which one trumps in terms of your thoughts of sell in May and go away? Do you stay in the market?
And again, you're saying you have two minds. It's true because I'm a hedge fund manager, so I have two mindsets. I'm always looking at both sides. But as much as I would love to sell in May and take the summer off, because we've made unbelievable money already this year. I mean, we've made enough money already this year for this year and next year. But on the whole, I think there's that fear of missing out. People don't pay me to go take a vacation in May when I've made enough money. There's that fear of missing out on more upside in the market, and I think that does trump. Don't say Trump, but I think that does. I think that triumphs over the fear of the market going down. I think we are in pretty decent position in the market, and I think that probably it's best to stick with it and keep going. All
right, let me squeeze in one last thing before we go to break. You mentioned Trump. What about Trump in Iran? With everything that's happened this week, I mean, oil moving up to new highs. That's helped the TSX actually, which I think a lot of people were quite surprised at. But what is your what is your take, I should say, in terms of the latest moves with Iran? I mean, is Iran's oil production really all that material to the market overall?
I think not as much as people think as a knee-jerk thing. It's not so much Iran's production because they produce about 1.8 million barrels a day, which is roughly what the OPEC has taken off the market. So it could be replaced, like that by OPEC just ramping their own production up. But, and also not everybody's going to comply. I very much doubt China's going to comply with the U.S. demand with Iran. They're still going to buy their oil. Iran's also going to sneak oil onto the market. So it's not going to have that big of an effect. The big deal, though, is when you hear Iran talk about the Strait of Hormuz and closing the Strait of Hormuz or blowing up the channel or mining the channel, 1/3 of the world's oil goes through the Strait of Hormuz. If that becomes a war zone, that will be disruptive. And that's where the real story is going to be, if there is one.